what does the election actually mean for your portfolio? Well, rather than leaving ourselves at the mercy of our own imaginations or the talking heads, let's see what the data actually shows. So in this video, we're going to talk about what single decision would be the difference between you growing your money from 1928 to $6.15 million or $655,000. We're going to look at which political party, so Republicans or Democrats, have overseen 1.8% per year faster economic growth. We're also going to look at 91 years of stock market returns in election years and non-election years. Then we're going to see whether Donald Trump or any other president has more of an impact on your financial future than a Netflix subscription. And then finally, we'll look at 4 things that every one of you should do in this coming election season. Lesson number 1 from the elections and stock market returns are that stocks usually go up regardless of whether it's an election year or not. This chart shows what stocks have done each year from 1928 to 2019. So if we look at the blue bars, these are election years. I've got the numbers in for those. The gray bars are the non-election years. So you can see that by and large, most of these election years are still quite positive. You've got 1, 2, 3, 4, 5 down years since 1928 that were also election years. If you look at the average over this entire time period, stocks averaged 11.9% per year. If you just look at the election years only, the returns were slightly lower at 11.6, and then the non-election years were 12%. So based on the historical data, the election years are about 0.4% per year less than non-election years on average. So pretty close, definitely not something to be overly concerned about. So the point is that election years don't appear to be any worse for your portfolio than non-election years. So let's just run a little experiment. So let's say you were to invest $100,000 in 1928. So under one scenario, we'll say you remain invested 100% of the time. In the second scenario, we're going to say that you went to cash for the entirety of each election year. So how would have each portfolio have done? So we see here that if you invested in 100% of all years, election or not, a $100,000 investment in 1928, roughly $1.5 million in today's dollars, that would have grown to $6.15 million by 2019. If you had simply skipped each election year, assuming that the market was going to crash each time, you would have had your money grow to $655,000. So 10 times lower return by just missing election years. So the lesson here is clear. By missing time in the market, whether it's election or not, you had substantially lower returns. The second thing we see from the historical data is that the party in charge really doesn't make that much of a difference. There's a narrative out there that Republicans are generally more pro-business than Democrats. Therefore, we might expect that they would perform better than Democrats in the economy and the stock market. However, that's historically not been the case. From 1853 to 2015, the average return for stocks has been about equal under both Democrats and Republicans. And Democrats have actually had a slight edge since 1960. If you look at economic growth, it's actually been about 1.8% per year faster under Democrats than Republicans. So the question is, are Republicans then not as good for the economy as Democrats? Are Democrats doing something that's better for economic growth? And research has looked into this and found that most of the difference in the economic growth over those time periods was more a result of things that were completely outside of the president's control. One of the studies suggested that as much as 70% of the difference between Republicans and Democrats as far as economic growth was due to oil price shocks. And another 22%, or 0.4 annually, was attributed to the increase in spending after the Korean War. So not all of the economic growth rates was really attributable to the specific politician or party that was in charge. The study actually found that there was no economic growth rate difference that could be attributed to fiscal or monetary policy. And one example is just looking at Bill Clinton and George W. Bush. So if we look at them, specifically how the market performed under both presidents, we see that Clinton was the president during the great technology bubble of the 1990s. So under his tenure, stocks actually increased by 17.2%, which is pretty impressive. It was actually the second highest growth rate of any president since 1928. However, most of that growth came from the technology sector, which Clinton really had nothing to do with. When George W. Bush came into office, that bubble was already in the early innings of popping. So when Bush came in, the US economy fell into a short recession. Again, that would have nothing to do with Bush or Clinton really. Yet the difference between the two presidencies, if you look at their returns of the market over their time period, Clinton was much more benefited by the technology bubble, and Bush basically took the blunt of the negative returns that ensued, despite neither president really having anything to do with that big market gain or big market collapse. And if Clinton had just been in office, say, one additional year, the results from his term would be far lower than they were in history. So therefore, the timing and the external conditions that are completely outside of the politician's control had a lot more to do with the returns than their underlying policies. And I'm not suggesting that the policies are irrelevant, but the data suggests that they're far less relevant than the news is going to have you believe. Lesson number 3 is that expert predictions about the impact of elections on markets are usually wrong. The talking heads on CNBC is going to have you believe that, if the Republicans win, that's going to be doom for society, or if the Democrats win, that's going to be doom for society. And these predictions really aren't anything new. Finger pointing has been a staple of US politics for a long time, and as most of these predictions completely failed to materialize. And see how bad. In 2008, the Obamacare narrative was that the entire healthcare sector was going to be ruined by Obama's bad healthcare policy. On March 23, 2010, the Obama administration and US Congress passed the Affordable Care Act into law. And most people thought this would be the end of healthcare stocks, particularly those in the insurance sector. The reality was actually quite a bit different than that. So if you look at over the next 2.5 years, the health insurance stocks actually produced just under 98% compared to 52% for the broader market. So not only did his policies not completely bankrupt the healthcare sector, it actually did quite well under his tenure. In 2012, the great financial crisis had just happened. The US economy was on the road to recovery, but there was a lot of debt and monetary policy stimulus that had happened since 2009. So in President Obama's re-election, there was speculation that he's going to completely destroy capitalism and the American economy is just going to go to ruin because of all this debt and all this money that's being flooded into the system. But instead of that happening, President Obama actually presided over the longest period of economic expansion in US history and the longest bull market in US stock market history. So again, that may not have had anything to do with Obama. It most likely had to do with the market and the economy that he inherited in 2009 and lower interest rates from the Fed. But the point is that Obama, being president, clearly did not ruin life as we know it, no matter how much Republicans would argue otherwise. And then the 2016 narrative was that Trump's election would be bad for the market. So it's widely expected that Hillary Clinton was going to win the 2016 election, and if Trump were to win, most people or most investors thought the market was just going to absolutely crash and we would end up with a huge economic recession. So let's just take a look at some of these headlines leading up to the 2016 election. So here is a quote from CNBC. "This is what could happen to the stock market if Donald Trump wins. The work of two economics professors may provide a glimpse of how the stock market might react if Donald Trump were elected. They studied the predictions market, including predictit.org, and the reaction in the financial markets to events around the election. One of the economists says their findings point to a sharp, immediate sell-off if Trump wins and a slight rally if Clinton wins." The Fortune magazine said, "Here's how much the stock market could plunge if Trump becomes president. Donald Trump promised he would jumpstart America with little difficulty during his economic speech in Detroit. Although if he is elected, he's more likely to stall the economy, according to St. Louis-based macroeconomic advisors. The Republican businessman, as president, the economic forecasting firms say, could wipe a hefty $2.1 trillion off the S&P 500. And finally, The Atlantic said investors think President Trump would wreck the world economy. They say Trump isn't just bad for his business, he's not even just a danger to the U.S. economy. Investors around the world think that a President Trump would be disastrous for global markets." Clearly, everyone thought Trump was going to collapse the market. That did not turn out to be the case. As a Trump victory became more apparent the night of the 2016 election, the stock market futures did decline by about 5%. However, as the shock from that started to wear off, people started looking at his policies. The stocks actually went up 6% from their nightly lows, and they ultimately went on to generate about 14% annual returns from 2017 to 2019. So ultimately, these predictions did not turn out to be true. Trump did not wreck the stock market. What did wreck the market during Trump's term was obviously the COVID-19 pandemic, but that's something that neither he, nor Clinton, nor Biden, nor anyone could have done anything about. Lesson number 4, the 299,999,999 are greater than the 1. So every politician wants you to believe that they are the savior of the world. The other person is the greatest threat to civilization ever to walk the earth, and you have to vote for them or the country is just going to be completely flushed into the tubes and we're going to wipe out hundreds of years of economic progress. And that is completely rubbish. There are 300 million people living in America. Actually, I think it's 328 million to be exact. But what matters far more than the one person sitting in the White House is the individual actions of the other 299 million people. Capitalism depends on these workers coming up with new products, finding ways of making things more efficient, and serving the needs of their fellow human beings. So ultimately, innovation drives stock prices, not the president, not Congress. So let's look at each of the presidents since 1960 and just see what innovations occurred under them. So first we have John F. Kennedy from 1961 to 63. The communications satellite, audio cassettes, and LED bulbs were created. Lyndon B. Johnson saw artificial heart, computer mouses, and barcode scanners. Richard Nixon saw the advent of the floppy disk, LCD display, and the very first video game. Gerald Ford, under him, we innovated laser and inkjet printers, post-it notes, and liposuction. Jimmy Carter saw MRI and the Walkman. Ronald Reagan was the president under which digital cell phones were invented, and Prozac. George Bush the first, www, World Wide Web, and the internet was invented, and so were digital answering machines. Under Bill Clinton, the personal GPS became widely available, the HIV protease inhibitor was created, whatever that means, and Google. George W. Bush saw the invention of the iPod and the iPhone introduced, the hybrid car, Facebook, and Blu-ray CDs, or DVDs, excuse me. Under Barack Obama, we saw 3D printing, Android, and the iPad released. So any single one of these would be worth multiple times more than the combined policies of every president over that entire time period. So if you look, researchers actually found that Apple was responsible for more in the market than the White House. Their products stimulated the economy with 2 million jobs. The app economy alone has led to the creation of 1.5 million jobs and has earned $16 billion for US developers, not Apple. That's in addition to Apple. And then the efficiency of small businesses, they found, resulted in $65 billion in cost savings from those businesses using iPhones. And finally, the fifth lesson is that the greatest influence of your financial future is not the president, it's you. So you can't really do anything about the election, but you can do a lot about your financial future. So what can you control about the election? I mean, pretty much nothing other than going out and voting for your candidate. The rest is basically out of your hands. So get to know each candidate and choose whichever one reflects your morals and ideas, and that's pretty much all you can do. The second thing you can do is control your savings rate. So let's say you have a $100,000 portfolio and there's a $10,000 decline due to whoever is elected president. Now that seems pretty unlikely based on the data that we've seen, but let's just say that hypothetically that were to actually happen. And let's say that 10% loss occurred forever, the market never recovered from that, it just permanently dropped by 10% and then went on to increase after that at a kind of normal pace. So if you would simply save an additional $7.36 per month and earn an 8% return, you would end up with $10,000 additional money in 30 years. So basically that means the presidential election's potential impact on your portfolio is less than the cost of a Netflix subscription. That also assumes the 10% decline is never reversed, which is probably not likely to be true, as we saw with the Trump election. The third thing you can do is improve your portfolio. So you could maybe allocate more of your assets towards stocks instead of bonds. Maybe you could find a better ETF that could add, even 0.5% per year to your return. Maybe if you're in individual stocks, you can focus on, a higher quality group of companies. There's a lot of things that you can do. Any one of those small improvements is going to be massively more important than any politician. And finally, take back your time. I think the most costly thing any politician could do to you is probably just consuming your time and creating anxiety. So every minute you spend thinking about the election or worrying about this candidate or watching the news is time that you're not spending doing other more valuable things, like focus on your education. That would maybe advance your career and help you earn more money. You could start a side business. You could focus more on your key relationships. You could read a book. You could mail an encouraging note to someone. So, the time you're going to spend watching election coverage is probably going to raise your blood pressure more than the portfolio. So just turn off the TV. I think you'll find yourself being less worried about the election, and you're going to have more time to devote to things that truly make a difference in your financial situation, and most importantly, to your life and your happiness. So just relax, vote for who you want to vote for, but don't let it keep you up at night worrying about it. Hopefully that's helpful for you guys. If you enjoyed this video, give me a thumbs up. If you want to get more videos like this, hit the subscribe button, and I'll hope to see you in the next video. Thanks for watching.